All right. Hello, everybody. My name is Chris Albrecht, and I'm with Open Water, and we are having the Navigating the Startup Landscape panel today. And we have three fantastic guests that I'm excited to get into a deep dive conversation with. We have Apurva Desai, Clayton Wood, and Neda Mansoorian. And what I'm going to do first is just have them each briefly introduce themselves and give us just a little bit of sort of your experience with startups. And I'm going to start with Neda, because I know that she is in the middle of one that she just told me about. So, Neda, why don't we start with you?
Yeah, I'm right in the thick of it. Thanks, Chris. Neda Mansoorian, really nice to be here. Thanks for having me. Let's see, I've had three careers. I started off as a restaurateur. I went on and became a lawyer and a chief legal officer. And then, if that wasn't enough, I decided I was going to be a tech startup founder. And my last company was a Salesforce Ventures backed tech startup. And I'm now on to my second one, as Chris, you mentioned. And we are building a marketplace that connects folks who need to book anything over 8 people at a restaurant. So basically, open table for groups, open marketplace. And we're heading out for our first raise next week. So here I am. Glad to be here.
Excellent. We are hitting you at the right time for sure.
You are.
Clayton, I go way back with you, so I know you know the startup game.
Yeah, thanks, Chris. Yeah, like Ned, I'm a multi-phase career early on as a mechanical engineer, then as an aerospace executive. Last couple of decades, I've been doing startups across industries, aerospace, renewable energy, precision agriculture, food automation. My last startup was Picnic. I was there as the CEO for about 5 years. Been gone from there for about a year, and I'm now in the portfolio stage of my career, doing consulting, advisory, and I'm a venture partner at Redstick Ventures, which is a food-centric seed stage VC.
Excellent. And Apurva.
Yeah, thanks. Thanks for having me. So my background, I grew up in the Midwest in Ohio. Then I went out to Silicon Valley and worked out there for about 2 decades, and now I'm back in the Midwest in Chicago. But my career has been predominantly as an executive in growth stage companies in the Valley. I started at big companies at Intel and Yahoo, and then increasingly went to startups. And I was at a mobile gaming company called Glue Mobile, and then a OTT video streaming company called ViewClip, which where I was CFO, and we got acquired by a large public company in Hong Kong called PCCW. I've now gone back to the Midwest. I'm in Chicago. I do some CFO work for startups in different segments, healthcare, education. I'm also a partner in an early stage venture fund out of Ohio called Interstate Fusion Ventures. So working with startups in a variety of different ways as both a CFO and advisor, as well as an investor nowadays.
Okay, Apurva, I'm going to stay with you here real quick. Thank you for giving us sort of your background there. How do you think, and I'm curious, both, from you and Clayton and Ned, actually, you have different perspectives in terms of like funding and raising money, right? How has the startup landscape shifted over the past 5 years? What do you think is like most important to investors right now? Apurva, I'll start with you.
Well, certainly it's changed in the last 5 years. And I mean, I think, we hear this term like the zero interest rate period, where investment was much more plentiful in 2021, for example. Looking at some data from Carta, there's something like 67 billion raised in Q1 of 2021 and 16 billion raised in Q1 of 2024. So obviously the magnitude is much less today than it was 4 years ago. Some of that change has been interest rates have changed. LPs and GPs are more conservative. But in that kind of change, we have seen a bit of this growth at any cost mentality. And we used to have a triple, double kind of expectation from investors in terms of growth. I think has changed. And we do see expectations of maybe not the same type of growth at any cost, but a path to profitability, healthy unit economics, and understanding of how to maintain a less burn rate, and knowing that now it used to be maybe the timeline from a seed stage to a Series A was 12 to 18 months. It's now more often 2 years. So you have to make that investment last longer, and maintain a burn in a way that, gives you that optionality and flexibility given these dynamics.
Clayton, I want to move on to you real quick because I want to get because you were hardware, right? Which is really hard for a startup, right? It's very expensive, very capital intensive. And now you're in sort of food seed stage funding, which again is a very sort of particular niche you're not doing like enterprise SaaS type things, right? Like it's very specific. So in sort of from your perspective, just looking at sort of those corners of the startup landscape, what have you seen that's changed sort of from running a company that was a startup now, especially now that you're on the other end where you are funding companies?
Yeah, well, like Apurva, I've seen the real shift, having raised money in what I finally think of as the free money era before 2021, when the game was sort of race to unicorn status, where you really could expect raise after raise, and you weren't so much concerned about your burn rate, you were really about raising your valuation. It really shifted very abruptly in 2022. And I personally experienced that trying to be in that market. And now what I see from the venture perspective is a very high focus on valuation as a key metric, especially for early stage. That you just, it's almost a killer to have too high of a valuation early on, because you aren't guaranteed to get that next raise. Specifically in food and hardware, both of which are hard categories to raise in. Food, despite the giant market, hasn't really achieved conventional wisdom that it's a big market stage in terms of VCs. And hardware has always been hard, but it's especially hard in this market where investors are very risk averse and very conscious about when you're going to reach profitability. And the key thing about hardware is it takes a long time to get to profitability, and it's difficult to get there without spending a significant amount of money. So balancing that burn rate, the valuation, and how long you have to wait for the next raise makes it even more challenging for hardware startups.
Got it. So people can't just like, once they've raised the funding, they can't turn off that part of their brain, sort of like, we'll just get it in the next round. Now they're just, people running companies got to be like, oh, well, Apurva, to your point, like the runway needs to be longer now in between your sort of your seed or even your angel pre-seed, whatever, right? And then to your series A. So you just got to be more, I guess you have to be more adept at juggling lots of different things. Neda, you've been going through this and are about to go through this again. So from that perspective, what have you noticed sort of has changed in sort of the startup landscape?
Well, one of my friends actually put it best. She said it's like alien chess is what we've seen in the last few years, which is basically, as a founder, you've methodically worked really hard to build this beautiful chessboard. You have all your pieces, and an alien comes down, takes your chessboard, throws it up in the air, gets back on their spaceship and leaves, right? So that was SVB, that was the market, that was OpenAI. All those things created all this disruption for us. So we have to start over again. I raised also during a time where things were, flowing, right? And now I'm going to be raising during a time that it's not so much. And so I've done a lot of homework. I've talked to a lot of people. I think for me and as founders, you have to really be prepared, to Apurva and Clayton's points, be prepared to really demonstrate that you are going to be capital efficient, that you have in addition to that, a very clear focus on a path, a solid path, a reliable, credible path toward profitability. But even before that, when is that break-even point? When is that? How are you going to get there? Not just, well, we're going to get there. Now it's a question of, well, how? And you better be prepared to be able to answer those questions. If an investor gets a whiff that you don't know what you're talking about, that you're not going to be able to lean down if you need to extend your capital. Some of them are asking 36 months. Are you going to be able to make it 36 months if you can't raise? All those questions, you really have to be prepared from the founder side to be able to answer those tough questions, or else it's going to be an automatic pass. You're not going to get your funding.
Now, all right. So I'm going to dovetail on that and stick with you, Neda, here real quick, which is, everybody's talking about AI. When you are building your platform right now, or you're imagining the roadmap for it, are you just like jamming in a couple of pages in your deck on like AI Are you just like, oh yeah, we're gonna be using,
Yeah.
Perplexity and Claude and all these things to do LLMs?
Yeah.
Like, is it just an AI word salad that you feel like you need to throw in there? Or do you know what I mean?
Yeah.
Like,
Yeah.
are people just like immediately like, oh, you need an AI page in your deck?
Yeah, yeah. So I think that for me, I've tempered all that and the desire to really come forward as being AI focused. I think that a good investor and investors that I actually think would be a good fit for us would see right through some of the froth that we're seeing around AI. It has to be really durable. It has to be sustainable as part of our business model. I mean, look, we're, like Clayton's saying, food, hard tech, all these things, they're hard. Hospitality marketplace is not fintech or health tech right now, right? Or all those, or AI. So yes, is there a desire or temptation for me to try to, wedge in that we're the first hospitality AI marketplace? Yes, but at the same time, I think that ultimately our company is going to stand on the fact that we're serving a real need, and I think that investors are still looking for that. They're looking for those big gaps. That said, I do have an AI slide. It's in my appendix, and it goes to things like, our operational efficiency. Our customer support is going to be AI driven, right? Our restaurants listings, we're going to help them write their listings so they're not staring at their computer for an hour when they're really busy. So it's going to help them write their listings for them. So all of those things will be baked in, and I'm prepared to talk about it with an investor, but I'm not going to lead with we are an AI company. I think most investors will see right through that.
Apurva, where do you see this as an investor, right? Like, and especially being outside of Silicon Valley, where we have all of, at least along the West Coast, you have all of these AI startups super well funded, you have all these things, right? But as you are looking at investments, or people come to you, where are you sort of at? Do you look askance at an AI slide now, or are you more critical is probably too strong a word, but do you understand what I'm saying? Are you able to sort of see through the BS? Like, really? You're gonna, your AI is gonna make whatever, doormats easier to manufacture or whatever.
Yeah, no, I mean, the way I think about it is, you know, we used to say there's cloud investing and mobility types of startups, and most companies in their roadmap have something to do with cloud or something to do with mobility. Now, am I going to call all of these investments cloud investments? Not necessarily, but I think most of these companies now there's probably something with their technology stack and so forth related to cloud. There's something related to mobility. There's something related to AI. I expect most of these companies now, they might not be creating their own LLM, but they're probably going to have some sort of use of AI in their roadmap. But that becomes kind of table stakes because they also have use of things that we used to call very specifically investments like cloud and mobility as an example. So, I don't see it as hey, this is an AI company. But I would be surprised if they're not thinking about AI, and I'm pretty sure their board is asking them what are you thinking about AI even before they talk to a new investor. So and I read somewhere like I think TechCrunch says 25% of Q1 2024 investments are AI investments, right? So of course there's 75% that they didn't classify as AI. So I'm not looking for necessarily an AI as on the title page, but I would expect they have AI somewhere in their their strategy.
Clayton, I'm curious because you were at Picnic, and for people who don't know, Picnic was like a pizza robot company. Like you could load in dough, and then it was really cool. It was a modular pizza making system.
Is, by the way.
Yes. Well, I'm sorry. Well, I was, because I covered it at the time, so it is. Sorry. But you had it. I don't think you ever talked about AI front and center as much, right? Like is enabled to like identify this is where the sauce goes, and it's not going to just like spray everywhere, and this is how much cheese needs to be put on, right?
Mm-hmm.
Do you think that I'm wondering, one, do you think that would change if you were around? Do you think that would change now, like sort of in the modern sort of funding place, like, because it seems like it fits right in to have that, and then at the same time being on that side and now being on the investment side, how you view AI. Do you see what I'm trying to say here? So it's like you had, a couple of years ago, nobody was talking about AI, but you had a device that did it. And now, so I'm just wondering if it changes the calculus on anything.
Absolutely. Yeah. So we were using machine learning to do our control systems at the time, and it wasn't, we would talk about it, and there's investors who were looking for that, but it wasn't a thing like it is today. And I think we went through a brief frothy period where if you said AI, you could get funding. I may read about some startups that were basically doing that for a little bit, for half a minute. I think it is much more, as I think Apurva raised, which is you absolutely need to be considering it as part of your roadmap. How will it affect you? How can you leverage it? How can it help you be more productive, or how can it help your product be better? I think specifically with regard to Picnic and automation, I think it's a game changer for automation, because one of the challenges of automation, especially food automation, where you're dealing with a really wide open input, which food is really diverse as an input, and you're trying to make consistent outputs. If you can leverage AI as a ever more sophisticated control system, then you don't have to spend so much time trying to fine tune your control logic, and you can use cheaper hardware, you can use cheaper control systems, and I think it can make automation be realized on a much shorter time frame. If you have commodity hardware with an AI-driven system that's properly trained, you can achieve great results in an unconstrained environment, which has been a fundamental problem in food automation specifically, because the more you constrain the environment, the more you limit the use case and you limit your market, and you try to be all things to all people, and then you've got a system that may throw cheese around, or it doesn't work as well, or it's really super expensive or super large. So I think in that industry particularly, it will be a game changer. It'll take a while to get there, but I think it's a big deal in automation.
Apurva, I want to hop back to you real quick. Before we got on today's webinar, one of the things you thought we should talk about was like startups used to be about growth at all costs, and that seems to have shifted. And so I'm wondering, how do you counsel when you make an investment? How are you counseling people to balance growth versus sort of reaching that profitability?
Yeah, I mean, I think, I think investors they do like their cake and want to eat it too, right? I mean, they are not going to say it's an either or, it's an and. They want to see growth, and they want to see path to profitability, and have the optionality, right? Like what the investors may want to do is say, okay, I believe you can get to profitability. Now we may invest so you can go faster and get additional reach and market share, but we believe that your path to profitability is there, and it's not just based on, hey, once we get to economies of scale and we get this many customers and this much volume and this much market share, then all of the healthy economics will come, right? Like there has to be a little bit more of how are we going to get there, and being able to articulate that. But so I mean, I think that is really important to understand the unit economics up front, articulate that in a defendable way, and then investors will be still pushing for growth, but maybe not the triple double that we used to always see, but maybe a little bit more rational levels of growth that combines with a believable path to profitability.
So I'm going to just follow up on that real quick. So when you make an investment then, and you're checking in on your portfolio companies, like how are you getting them to sort of balance that, right? Are they coming in with that mindset already, or are you having to temper like, hey, everybody, you need to ramp things up, or you need to lower your expectations? What are you sort of finding that you are doing to sort of help people?
I think, and I think it depends on where they are in their maturity level, if they're a Series A company versus pre-seed versus seed. But certainly if you're in a Series A company, I think they have already understood that this dynamic has changed, right? And they need to be able to articulate a healthy economic model and a business model that has key levers that are defendable on how they're going to get to certain gross margins and profitability. Now, earlier stage startups founders may not yet have that full understanding of how their business model is going to evolve and how they're going to get to a specific product market fit, et cetera. But I think they know that they have to be thinking about this, and as they evolve, they have to have spend the time and understanding of what are our key drivers to get there, what needs to be true for us to get to that level of gross margin or profitability path. So I think that understanding is starting to be clear to founders of different levels of maturity nowadays.
Neda, it sounds like you were already like, these are things you talked earlier, like you have the roadmap. Okay, now how are you going to get there?
Right.
But as you sort of hear this, and as you are thinking about your own, like you're going out to pitch right now, right, to raise funding, right? How are you sort of balancing on your end, like on the founder side? Oh, I need to grow, but I need to maintain sort of, they say happiness comes from setting proper expectations. And so I'm wondering how you keep your these potential VCs happy with your sort of expectation setting.
Yeah, I mean, I think as a founder, I'm painfully aware of the fact, first and foremost, that a lot of times growth equates to burn, right? So I have to keep my finger on the pulse of exactly how, that kind of calibrating those levers around how much growth do I push on? How much does that mean in terms of headcount, right? So all of these things like build on each other. For me, it's really going to be a balance with this company of being able to and being able to show, and we've been thinking about this, my co-founders and I have been really looking at this very thoughtfully, because aside from going out and having a good story to pitch with, we all have better things to do. And so if the model doesn't make sense for us and it doesn't make sense for investors, we shouldn't be doing it. So we've been really thinking about, like, what do we need to do to get to X, to get to Y, to get to Z, and not burn out, right? That runway is like, always on that shoulder of the founder every single day. So for us, we've looked at things like, okay, we are going to grow at a certain pace. Marketplaces are, by the way, weird, right? You've got to get that flywheel going. It's like you can't just like slowly get, chase the whale contract, right? So you have to be able to really be methodical and give yourself the time to build the flywheel. So things for us that are going to be really important are going to be churn rate, the user rate. The more traditional stuff is still going to be important to us, right? The active users, repeat rate, all those things are going to be part of the calculus for us because it's a marketplace. So, I think that having a really tightly aligned relationship with your investors is super important. You talked about expectations and managing expectations. I have excellent relationships with our co-lead investors from my last company, because there was so much communication, and they were former operators. So we were talking a lot about a lot of things. So nothing ever surprised them. So I think that's a big piece of it too, is just kind of viewing your investors as part of your team and help and getting their help in sort of developing the plan as you go forward.
I just want to follow on real quick, given that you are going back out, and what has changed? What did you learn from the last time that you were applying to this time?
The very first thing I've learned is that don't expect that what the world is going to look like when you first start your company and you first raise is going to be basically what it's going to be like by the time you get to market. I think that the big things for me, the biggest lesson for me, and I think that I was part of that group of people who was burning fast and relying on the idea that, we're going to actually raise again. And we're going to raise again, and we're going to raise again. And there was this whole thing about it. The biggest thing for me is that I would grow a little bit more slowly at the front end of it while we're in development. So slower headcount. So every time that you add a headcount, it's got to be directly tied to what's happening in the business. Very much so, as opposed to we're going to build. We're going to grow. And just being more thoughtful about, I think burn is a big one for me, and probably for a lot of founders out there this time around.
Clayton, I want to, as you are now an investor I wanted, is anything in sort of the funding models, the traditional sort of structures, is it pretty much still the same, right? You have you sort of bootstrap, angel, pre-seed. I mean, because there were times in the past 10 years, I think, where like pre-seed funding was like $20 million or something, right? Like they would just, these insane numbers got assigned to what was traditionally very small rounds. And I'm wondering if you think that it was sort of just like a blip in terms of the, like a rise quickly and fall just as quickly trend, or where do you see sort of the funding structures happening right now?
I think those labels continue to be pretty soft and move around a lot, what they mean. Clearly, the labels are much tighter now than they were 3 or 4 years ago, and I think the actual funding at, say, seed level, you can look up averages, but there's really tiny seed rounds and there's pretty sizable seed rounds, and it goes to valuation. And so I've been mostly focused on very early stage pre-seed seed level companies, and that valuation is very key, as I noted earlier. And one reason for that is if you're a small investor investing a small amount, you can't afford to be putting, say, 250,000 into a round where the pre-money is 20 million, because you'll never get your multiple to return your fund if you're a traditional VC model. So you need that valuation to be lower, and in fact, it reflects the risk level. If the I think, going to Neda's point about people being more methodical, the risk is real, and there's a lot of risk that you get funded at seed and you never make it to A because you never found product market fit and you never found that growth niche that you can rely on to do the next round, because the bar keeps getting raised much more meaningfully than it did a few years ago. I think part of what happened a few years ago was there's a lot of forgiveness. Oh, you're on a trajectory. You haven't found product market fit, but look how great this is, and look how giant the market is. And you could keep getting funding without necessarily achieving the kind of milestones. I mean, I think traditionally Series A would indicate you've kind of arrived, you've got a business model, you've got product market fit, or at least you're close to it. You've got a real business that is ready to consolidate and really start growing. And I think now that if anything, that's even more true. So when I'm talking to very early stage companies, I'm really encouraging them, find product market fit, find that early customer who will adopt your technology, and will leverage it, and don't be concerned about chasing big names. Big names take a long time to make decisions, and what looks like fast growth without product market fit is probably just a fool's gold, and you can get into a trap if you think you're going to sign the big customer that sort of is excited about your product, but it's not really finished yet. You can get yourself into a lot of trouble chasing that kind of a deal.
We're talking about that a lot today. It sounds like, just right, like moderating growth, and being very thoughtful and intentional with the way that you are growing. Before I want to stick on you for a second, Clayton, which is like, do you have a thesis around sort of how you invest, or your or Redstick, in terms of what they are looking for and what you are looking for when you invest in the company?
Yeah, so it's really a lot of it is about value, and some of that value is just the traditional measures. Is there ultimately a large market? Is the technology that's being developed unique and differentiated and high value to customers? Depending on the stage, the importance of the presence of customers depends. The earlier you go, the more you can get away without having customers signed up, but the more reliance there is on, wow, this is amazing tech. I think, for my part, I'm very sensitive to the technology adoption problem, especially in the food world, in hospitality and restaurants. Any agriculture is the same thing. Any place where you have an industry that's not really all that accustomed to innovation, and you have something that's very new, what I call the spaceship in a cornfield problem. It's really amazing. Everybody's excited, but nobody knows anything about it. They don't know what it should cost. Nobody knows anybody who has it already. You get a lot of excitement and very few buyers. And so if you don't have a solution to that, you better spend time finding your customers before you spend a lot of money on product development.
Got a lot of alien talk today. They're playing chess. They're landing in cornfields. Somebody ought to invest in some kind of SETI program, it sounds like. Apurva, I'm wondering, you say that you are like a CFO and an investor, and I'm wondering how that's like peanut butter and chocolate, right? Like, how do those things mesh together in your mind as you are looking both, I guess, as a CFO and as an investor? You're sort of right in the middle there.
Yeah, I mean, as a CFO, what I've been trying to do is help companies have that responsible growth, right? So in the more recent time, a lot of that role has been, how do we help that company with fundraising, but also creating an environment where there's understanding of that path to the different gross margins or path to profitability, helping the teams understand how to look through those different levers, but also being so part of that is that side, right, is just helping them with that responsible growth on the CFO side, but then taking that mindset as well, investor side, to say, okay, now I've seen founders who have this mindset, that they have some of that understanding, right? And I've recognized some of these patterns of some founders who are thinking that way more so than other founders. So seeing both sides is sometimes helpful for the investor side. But I've spent my career helping companies grow, get to different transaction levels, get to from stage A to B to C, and then trying to understand what some of those patterns I've seen in successful founders, as I then look at it from an investment perspective.
I feel like it's interesting in all the talking today. I feel like we're in sort of the parental stage of funding. Like 10 years ago, it was the crazy drunk uncle who was like, yeah, money, 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 do whatever. And then now it's like the parents have come in and been like, okay, well, what's your plan? How are you going to get there? What's going to happen? It's very interesting. All right. As we wrap up here, I want to go around the horn here real quick and just let's give some practical advice for people, right? Like, Neda, I'm going to start with you because you're in the middle of it. But if someone has a company, they have co-founded something and they're going to go out for funding, what's the one piece of advice you have for them before they go out?
The one piece of advice is to be prepared for the fundraising to take a while. So give yourself enough time, whether you're between rounds or you've been bootstrapping and you're trying to keep the lights on, give yourself a lot of time. It's going to take a lot longer than it ever used to.
All right. Clayton?
Yeah, I would say be prepared to talk to a lot of investors. Investors have hundreds of reasons to say no, and they can be as innocuous as, our fund is at the wrong stage, we write the wrong check size, you're the wrong stage for us, you're the wrong vertical for us, you're in the wrong geography for us. There's a million things that you can't always find in research, but be as prepared as you can be with your own story, know your own answers, know your numbers, know your business, know exactly where you are, and find that right fit. Because fit, as I believe Neda said earlier, finding the right investor early on who will be with you and be your ally is hugely important. Just getting money, if it's from the wrong investor, is probably going to cost you more trouble than it's worth.
Apurva?
Yeah, so I would add to that, understand the investors, kind of do your screening sometime before. It's gonna take longer. You're gonna have more meetings. So the more meetings you can kind of not have, because you kind of have a better sense of, yeah, these guys are not going to be the right fit for us, will be helpful to you. And then I think also, right now the likelihood of having bridge rounds has been higher. So look at investors also saying, well, which one of these investors are likely to support me in a bridge round, because we can't necessarily get to that next price round as fast as we wanted to, right? So these investors, if it's one and done, it may not be necessarily the best investor for you at this time? Are they likely to follow on, even if we haven't gotten to that next seed round yet, and be there for a bridge round?
Excellent. Apurva Desai, Clayton Wood, Neda Mansoorian are not only startup experts and investment experts in the startup field, they're also members of Open Water, and I appreciate your time being here today. Thank you all so much.
Thank you, Chris. Thanks, everybody.
Thanks,
Thank you.
Chris.
Thanks.